Global stocks fall the most since March 2020 after Donald Trump's Liberation Day tariff shock. The Aussie and Kiwi dollars slump after China retaliates with its own 34% tariff, and ANZ Research now sees the Reserve Bank of Australia cutting 3 times this year rather than 1. That's coming up in our 5 Things in 5 Minutes on Monday, April the 7th. And then in today's bonus deep dive interview, ANZ's Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at the potential effects of the 26% tariff rate on India's exports to the United States and what the Reserve Bank of India might do about it at its next decision this Wednesday.
The next meeting is actually just around the corner, and it would be interesting to see whether they go by 25 basis points or they realize that the situation is quite serious and they may need to go by 50. If they go by 50, that would sort of signal a strong change in how policy is being conducted in India.
But first, in 5 and 5 with ANZ, global stocks fell the most last week since the COVID slump of March 2020, after Donald Trump first slapped higher than expected tariffs on all its imports, and then China retaliated in kind on Friday night with 34% tariffs on all US imports. The S&P 500 fell another 5.6% on Friday, taking its losses since the Liberation Day tariff announcements to 10.2%. That's the 4th biggest 2-day fall in history, behind the crash of 1929, the 1987 crash, and that slump in March 2020. Here's ANZ's head of G3 Economics, Brian Martin, talking on Saturday morning from London.
What really reinforced negative market sentiment today was the statement from China that it will impose a 34% tariff on imported goods from the US effective the 10th of April. Markets have taken this very badly as an escalation in a trade war between the world's 2 biggest economies.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up around 1% from Friday morning. The US 10-year Treasury yield closed down 19 basis points on Friday at 4.0%. The Aussie dollar fell 4.6% to 60.36 US cents, and the Kiwi fell 3.4% to 55.95 US cents on Friday night. More on that later. Gold closed down 2.6% at $3,041 US dollars an ounce, and West Texas Intermediate oil futures fell another 7% to close at $62.05 a barrel. That's down from $67 a barrel before Liberation Day. Number 2. US Federal Reserve Chairman Jerome Powell worsened the slump on Friday night by saying the tariffs were worse than he expected and would both slow economic growth and increase inflation, which meant the Fed would take a wait-and-see approach rather than cutting immediately.
The Fed wants to ensure that any price rises owing to the tariffs don't become continuous and therefore inflationary. So he didn't send any signals that the Fed are about to cut interest rates because of this extreme stock market weakness that we're seeing at the moment. He very much said, we're on hold now. We're going to watch what impact the tariffs have on inflation before moving in interest rates. And I thought that was really interesting because the market thinks he could be cutting interest rates as soon as June.
Number 3. Brian says the sharp sell-off at the end of last week, in combination with the effects of those tariffs on company earnings, risk creating a sort of negative feedback loop in markets.
Everything just points at a reduction in profit margins at this stage, and that's driving equity markets down. And as equity markets come down, we've got a lot of leverage in the system. So people who are leveraged and have got stop losses, and they need to sell, and that's forcing equity prices down. So we're into a bit of a negative vortex at the moment that is really quite concerning. The likelihood is, though, that policymakers will be working behind the scenes to see if they can create some space or some time to get to a negotiation table to try and resolve this measure.
Number 4. The Aussie and Kiwi dollars also fell sharply on Friday night, seen as currencies sensitive to risk and vulnerable to any hit to growth in China. The Aussie fell 4.6% to 60.36 US cents, and the Kiwi fell 3.4% to 55.95 US cents. ANZ's head of FX research, Marja Ben-Zaman, said last night that markets will be watching the People's Bank of China closely.
The Aussie continues to operate as a liquid proxy for shifts in sentiment regarding China, and that's really played out. The Aussie dollar continues to also be highly sensitive to fluctuations in the renminbi, so we will be watching closely to see if there is any adjustments of the CNY fix by the PBOC, and that will continue to have impact on the Aussie dollar and even to some extent the Kiwi dollar.
Number 5. Meanwhile, ANZ Research has changed its call on how many rate cuts it expects from the Reserve Bank of Australia this year, from 125 basis point cut in August to 3 cuts this year, 1 each in May, July and August. Here's ANZ's head of Australian economics, Adam Boyton, on how the RBA will view the inflationary effects of tariffs.
on balance, the Reserve Bank will take the view that the negative growth impact will outweigh any, if you will, second round inflationary impulse on Australia. I also think when you get these sorts of global risk events and potential global shocks, the importance of inflation tends to dissipate a bit for central banks, and it is a bit more about the growth and the activity outlook.
Adam Boyton there. Now, in today's bonus deep dive interview, ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, analyses the potential effects of the 26% tariff rate put on India's exports to the United States, which he said was much greater than expected, and at its worst would reduce exports by $30 billion or 0.8% of GDP.
I guess it could be tempered down for two reasons. One of the critical exports, pharmaceuticals, has fortunately been excluded from the tariff list as of now. Second, it does seem that there would be some sort of trade negotiation or a successful trade negotiation. So net, our view is that this could potentially be a hit of about 0.5% of GDP.
And looking at the wider effects on the global economy of a global trade slowdown, how might that be a secondary factor in any sort of economic effect on India?
I guess so. 0.5% does consider a slowdown in global trade. On the more sort of positive side, we should say that India's trade to GDP ratio is amongst the lowest in the region. I think it's just slightly above Indonesia. So in that sense, it's really how the domestic demand behaves, and domestic demand is also somewhat independent of export dynamics.
And how have local financial markets and the rupee reacted?
Reasonably well, I would say. The rupee, similar to other currencies, has actually appreciated, surprisingly. I guess the bigger point here was that the equity markets, which we had expected to be completely pummeled by the tariff rate, that has fallen quite marginally, if you like. The fall yesterday and today is not any different from any down day, really.
And the rupee, which in theory could act as one of the shock absorbers here.
Yes, it can. And more so because after the weakness it sort of displayed during February, it has rebounded quite handsomely. And that sort of gives the RBI more space to let it weaken without fostering any sort of imbalances. The second point really I should stress is that even though the currency looks fairly valued, India's exports were on the weaker side even prior to the implementation or announcement of tariffs. So our expectation was that the RBI would be happy to see it weaken a little more.
And thinking about the Reserve Bank of India's interest rates, what do you see now for its monetary policy stance?
Our base case is that over the course of 2025, we'll see 75 basis points of rate cuts. The next meeting is actually just around the corner, and it would be interesting to see whether they go by 25 basis points or they realize that the situation is quite serious and they may need to go by 50. If they go by 50, that would sort of signal a strong change in how policy is being conducted in India. Along with that, we will watch for whether the stance of policy is characterized as accommodative this time or not.
And just looking at inflation, there's been some discussion that countries in Asia and, of course, China may want to export goods at a cheaper price to other parts of the world than the United States if their sales there are affected. Could that help reduce inflation at all in India?
Absolutely. And I think that the sort of reduction in export prices naturally translates into lower pricing power in the corporate sector, and that would at some stage feed through wages. So that's one source of disinflation. The other would be that if China has to penetrate into export markets other than the US by cutting prices, that would be a source of imported disinflation. Third, commodity prices, particularly oil, are still quite weak. So overall, we could think that India will have fairly modest inflation this year.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, April the 7th. Catch you tomorrow with more on that ANZ Research call change from the Reserve Bank of Australia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.